Hey, it's Jim, and this is level 3 of the CFA program, the topic on equity portfolio management, and the reading on active equity investing, portfolio construction. And since this is a relatively long reading, we've divided this into 2 parts, and here's part 1. I was fascinated by the first paragraph or 2 of this reading. Let me go ahead and paraphrase it for you. The 2 authors, both of whom have PhDs, by the way, define active equity investing as the ability to identify overvalued and undervalued securities. That's not new, right? You guys have heard that multiple times, if not a million times. But the paragraph then goes on to say something like this. Hey, if we are really good financial analysts and we evaluate 100 stocks and we rank them from best to worst, why don't we just invest all of our wealth in the best performing stock and then short all of our wealth in the worst performing stock, or at least the best and the worst expected performing stock? And so you see that's a little bit of this active investing is kind of it's kind of a paradox. Is that the right word? I don't know. But what we want to avoid is thinking that we're too smart and that if we have these handful of stocks, we're not going to have the benefits of diversification. And so the idea here behind active equity investing is to find the best stocks for our individual or institutional clients so that we can deliver all the promises that we make when crafting the policy statement. So we want to take advantage of diversification, but we also want to take advantage of our skill set. So this reading could really be called, active equity investing, combining the layers of the beauties of diversification with all of our skill sets that we've learned and are learning inside of the program. In this part 1, we're going to take a look at just 3 LOSs, and we have 40 some slides in this slide deck, and then we'll go ahead and do the final 5 in part 2. But notice, our focus is going to be on active share and active risk. We'll talk about approaches. We'll talk about philosophy. One of the interesting things about this reading is that there are only, even though it's almost 70 pages long, there are only 15 multiple choice problems at the end of this reading. And so I'll let you guys try to figure out what that means. But we're going to end this slide deck with what we believe are probably the most likely types of questions coming out of this reading. So let's go ahead and start with a brief recap. Let's think about this active equity investing. When we get this notion of active, we get the idea that what we're trying to do is outperform some kind of a benchmark. The reading calls it a pre-specified benchmark. There are some examples there for equity and fixed income benchmarks, but essentially what we're trying to do is outperform the market, whatever that market is. It could be the S&P 500, or it could be a benchmark of 41 securities that look an awful lot like the 40 or 50 or 60 securities inside of our portfolio. Yeah, this is what I was saying earlier about why don't we invest all in one stock and short that worst stock. No manager, of course, perfect foresight. Predicted returns, of course, are going to differ from actual returns. And that harkens us all the way back to level 1, where in quantitative methods, we introduced this concept of variance or volatility or standard deviation. And that's what we're going to do inside of the first part of this reading. We're going to take a look at, something that might look a little bit like standard deviation, but essentially we're going to just take the difference between predicted returns and actual returns, or actual returns and benchmark returns, or we're taking the difference of returns and then we're going to evaluate them. Yeah, that second arrow point, you don't need me to read that, right? Portfolio construction, we're picking the best securities for each of our clients, and then we're going to determine the percentage in the portfolio. The easiest way to do this, and hopefully you remember me saying this in previous recordings, the easiest way to do this is just to shove it into Excel and use the solver function to find optimal portfolios. Of course, you guys in the financial services industry, you probably have tons and tons of software that does it for you, but every algorithm is a function of the Harry Markowitz 1952, and that was his dissertation, by the way, when he found that efficient frontier. So what are we doing as active managers or active investors? We're going to have a couple of different strategies. We can do long and short, like I was saying earlier. We can do long only strategies, which is probably the most common that's out there, especially for individual investors. But then we can also take a step back and say, all right, here we are nearing the end of level 3. What's all the stuff that we learned that is supporting this portfolio construction? So we'll look at systematic strategies and we'll look at quantitative strategies. Of course, that Harry Markowitz was part of a quantitative strategy. All right, so let's start with that first LOS here. Elements of a manager's investment philosophy. All right, so let's go ahead and define active return. It's really just the excess return that the active portfolio generates over top, or I guess I should say over top or under top. Is that a word, under top? How about underneath the benchmark portfolio? And so, of course, we want to have some value added. We don't want to have a value subtracted from our active investing. And of course, the results are going to be from the difference in weight. So let's work through a really quick example here. So we've got security A and security B. Look down at the bottom. So security A returns 25%. Security B returns 15%. The benchmark is an equal weighted portfolio, 50% in A, 50% in B. But what we're doing is we're overweighting security A by an extra 20%. We're underweighting security B by 20%. Everybody see that? The difference between the 50 and the 70 and the 50 and the 30. And so the question is, let's go ahead and compute this active return. Now let's work through the math here the long way. This is probably what you learned back in, I don't know if I taught you this back in level 1, or maybe you learned this back in college. But take an equal weighting of A and B, so 25% and 15%. Well, you don't need your calculator for that, right? So that's a benchmark return of 20%. That makes sense. But let's go ahead and look at the active portfolio. So we have 70% in 25. So what's 7 times 25? That gets us up to what? 17 and a half. And then 30 times 15, that's what? 3 times 15, that's 4.5. So that gets us up to 22%. So the active return was 22%. The benchmark return was 20%. So our active return is just 2%. Take the difference between those two. Now, the reading doesn't go through that really long-winded way of computing the active return. What it does is what we've done here in that bottom box. So for security A, what we're going to do is take the 70 minus 50, that gets us the 0.2 times the 25%. And then take the 30 minus the 50, that gets us the minus 0.2 times the 15%. And there's the 2% difference between the 22% active return and the 20% benchmark return. Boy, that was long-winded stuff. On the exam, when you get a little table like this, you'll probably forget about what I just taught you the long way. But clearly, it gives you a sense that this active return is truly the active return, not some manipulation of some numbers on a table. All right, so this top part of this slide is just a repeat of what I said initially, right? An active return is positive if and only if, right, the manager overweights securities that outperform and underweights securities that underperform. And that makes perfect sense. So we could have another part of the slide up there. The active return is negative if, and then you would just flip those two things, right? So what's the goal as a financial manager? Of course, the goal is to have a positive active return. Well, what are the sources of those active returns? Well, there's lots of different sources. One of them is just luck. Let's just suppose that the benchmark returns 12% and I somehow magically generate 20% during the course of the year. Well, I could be the biggest knucklehead, right? And I could have outperformed the portfolio just by sheer luck. There's lots and lots of academic research out there that tries to identify those lucky managers, and clearly the evidence shows that those lucky managers then become unlucky in subsequent periods. But luck is only a small part of the sources of active returns. So what are we doing? We're going to go ahead and use all of the material that we're learning in the CFA program, and we're going to try to find these factors for which there is known and sustainable and persistent compensation. The reading calls these rewarded factors. All right, so we know all about the market portfolio. We know about the size effect. We know about momentum. We know about value. We know about growth. And maybe there are some other factors out there that you guys on the cutting edge of active management are aware of that we don't know about yet in the academic world. But I can tell you that in reviewing the academic research, there are lots and lots of professors out there trying to find these other kinds of factors. Now, of course, here, let me go back here real quick. So rewarded factors and then return from mispriced securities. And this is, kind of that mosaic theory that we learned about back in level 1, that skills, experience, identifying mispriced securities. So what I want you to do is I want you to visualize the Harry Markowitz efficient frontier, and then couple that with the security market line from William Sharpe, and just try to ask yourself the question, what are we trying to find? We're trying to find those securities that are up in the top left quadrant up there. We might call them unattainable if we're Harry Markowitz. We might call them undervalued if we're William Sharpe. And then, of course, idiosyncratic risk. That's the luck stuff that I was talking about just a few moments ago. Now, the question then becomes, what was that example I gave earlier? I was a lucky manager and I generated 20%, and the benchmark was 12%. So what we're trying to do is explain the difference between 20 and 12, which is 8%. So we call that the decomposition of the active return. What we want to do is chop that 8% into its components. And what we can do is we can try to chop it. Now, this is not a perfect science, but we can try to chop it into luck. We can try to chop it into skill, and we can try to chop it into these factors that are rewarded. And that's what this equation looks like there. So notice that we have this active return on the left-hand side of the equal sign. And all we're going to do is we're going to go ahead and sum the difference between our betas or our sensitivity. So look inside of the parentheses. You have the beta of PK and the beta of BK. So that's just our portfolio and the benchmark for each factor, right? K factor. And then we're going to multiply it by F sub K, which is the return to that particular factor. And let me go back here real quick. Where was I? Yes. So maybe we had a sensitivity that was 50% higher for momentum. And then what we would do is multiply it by that momentum factor, and that's the decomposition. And so if you sum those, throughout the portfolio, you're going to get the reward for our, let me just call it factor analysis for lack of a really better term. And then at the end, we're going to have the alpha plus the luck thing there. So let's do just a quick example. And remember what I said a few moments ago, that we have a couple of problems at the end of this slide deck that I think are very likely to show up on the exam. And here's another one. Look at the question at the bottom. What drives returns for the two managers? So we have manager A and manager B, and we're given a table. So look over on the far right column. Here are factor returns. So we got the market factor, we have size, we have value, and we have momentum. Notice those are relatively small, but don't worry about the low percentages of those things, because they're going to, here, let me just show you real quick. They're going to get multiplied inside of here, and that's going to turn, well, what was my example? The 12% benchmark return into the 20%, depending on 20% my return, which what did I say? It was mostly out of luck. All right, so look at the two columns in the middle, manager A and manager B. Well, there are differences in alpha, so manager A has 0. And then there are differences, sensitivities or betas. So manager A has 0 for size. Manager B has nothing for value, right? And then some other things there. And this is really important. Down at the bottom is the R square. Let me just quickly remind you that R square measures the explanatory ability of one variable, or the changes in that variable, or the variability in that variable by another variable. And so what we're saying here is how do these factor returns explain the performance of manager A and B? So clearly manager A is superior in terms of being able to generate a higher R squared. We'll talk about what that means here in just a second. So let's go through this quickly, and I'll toggle back and forth if I need to be. So manager A. Performance can be completely explained by the exposure to rewarded factors. Of course, that's why I mentioned just a second ago that the alpha was 0. There's the high R squared, that those 4 factors explain much of the monthly variability in returns. That makes perfect sense. Now, boy, I'm going to go ahead and pause and take a deep breath. And I'm going to give you absolutely no advice on what is a good level of R squared. This is something out there that, we really don't know. It's one of those things that is way more art than it is science. But the important thing for exam answering is that 74 is greater than 59. So, right, we're comparing these two managers. So I think we can reasonably make that conclusion that manager A has a higher R squared. Therefore, those 4 factors have much more explanatory power than for manager B. All right, what's that middle box down there? Yeah, manager A outperformed the market by, what is that? Whoops, I went the wrong way. 15 basis points. Yeah, that makes perfect sense. So look at the market over there, 34. There's the monthly performance, 49. So there's that 15 difference. Significant exposure to the strongest performing value factor. Oh, I keep going the wrong way. So look at the beta 0.19 all the way over to that 0.45% under value for that factor return. So manager A made a super bet on value and was rewarded. And then momentum would explain the rest of that. All right, what about manager B? Significant alpha. Oh, that makes sense. Let me go back there, right? 0.15. Relatively low R squared, so that, boy, there's a lot that is left to be desired, as my mother used to say to me. There's a lot left to be explained, which means, of course, that the remainder of the performance for manager B has to be attributed to either alpha skills or luck or noise, however we want to refer to it. The reading calls it idiosyncratic risk. So I would make sure I knew that term for the exam. But inside of that alpha skills, now this reading doesn't emphasize this at all. But in other parts of the CFA program, what we do is dive into further decomposition. So in alpha skills, we can identify whether the manager has superior security selection or asset allocation or currency selection or geography selection, or we can break down those alpha skills in further manners, but we don't do that inside of this reading. All right, so let's just summarize there. 3 building blocks. Look at the green. So the factor weightings, the alpha skills, and then the position sizing. And so if you put those all together, you get something called breadth. Let's go ahead and look at that first building block, overweight or underweight those rewarded factors. And this is really what the CFA Institute is trying to get us to do from, the very first days of level 1. What was the very first thing that I said in the very first level 1 recording? I think now it's time value of money back in level 1. So I said something like, we have $100 today. You have $110 next week. What's the interest rate? And so we did all that time value of money stuff. So that's really the first building block, time value of money, and then capital budgeting, then bond pricing and stock pricing, and then Harry Markowitz. And all of a sudden we're here. Let me just go back here real quickly. All of a sudden we're in the building blocks used in portfolio construction, which, this is what a cool name, because we have been building these blocks now for a long, long time. Hopefully not too long a time for those of you. Hopefully you passed level 1 and level 2 pretty quickly. All right, there are the alpha skills. So skillful timing to exposure of rewarded factors, unrewarded factors, markets, and securities. This is what I was saying just a few moments ago. And so that has a couple of different components. So factor timing and the timing exposure. You may have heard me say this before. My wife she's way smarter than I am in many, many things. And, before we got married, we were saying a whole bunch of stuff about our life and our plans. And she was like, you know what, dude? Timing is everything. It's time, and so it all kind of amalgamated together, and it was right. It was the right time to get married. And so, marital example is not the greatest analogy, but clearly what we're trying to do is we're trying to find stocks and bonds and, just stocks here in this reading, but bonds and alternative investments and derivative securities where we can get these individual securities married to form that perfect portfolio for each of our individual clients. A really interesting paragraph inside of this reading is this concept of these unrewarded factors. I hinted about this maybe 15 minutes ago. Have not yet been shown through empirical evidence. That's really important. Persistent. I used that word earlier. Persistent and sustainable return premium. And the reading mentions energy prices. So here we have commodity in the purple over there. But it also mentions sector exposures and regional exposures. There might be some type, let's just pick the United States. There might be, and I'll just pick a state, there might be an Idaho factor. And it might be, now I'm going to make this up here, it might be that Idaho, do they make potatoes in Idaho? You hear about the Idaho potato. That might be a factor that, boy, if you go to Bloomberg and do the supply chain function in that Bloomberg software, that is so cool. I hope you guys do that. You might find that on this side of the supply chain and on this side of the supply chain, for a lot of different companies, there are farms in Idaho that are on both sides of the supply chain. And if we could uncover that Idaho potato factor or just an Idaho factor, that might be something. I promise you there's somebody out there doing research for that. So sector exposures, I didn't mention that, and security selection. There might be other things like, what do we know? We know we can take dividend yields and we can make a determination on dividend yields, at least a general determination about whether that stock is a value stock or a growth stock. But maybe there are other factors, value and growth, that you can infer from maybe a dividend payment, or maybe total dividends paid by the firm, or maybe growth rate in dividends, or maybe dividend yields. There might be a factor that is rewarded, but we just don't know about it just yet. And that's all part of the mosaic theory. That's all part of trying to push that security market line up this way, and the efficient frontier, right? We're trying to identify all those stocks that are going to increase in value. All right, this third building block, position sizing, this is the manager. It's essentially the manager's confidence in, what kind of insights they have to the Idaho factor or the value factor. And this is an important part of this third building block, while mitigating, while lessening. Now, notice it doesn't say minimizing. I always am fascinated by when I read those terms, because when I read minimizing, I think of Excel and Solver. When I think lessening or reducing or mitigating, I think managing. And so there's some artistry, there's some science in managing these idiosyncratic risks. It's luck, but in the academic world, we kind of call it noise. And what we want to do is try to minimize that noise. All right, so there are some examples down at the bottom here. So a factor-oriented manager, the goal is to have factors that have balanced exposures, right? You guys ever watch Seinfeld on that one episode where he always wins and he always loses and his friends are up and down, and Jerry goes, "I'm even Steven." And so that's exactly what's happening here in this factor-oriented manager. You have factors over here and factors over here, and they probably tend to offset each other. And that makes sense, highly diversified portfolio. So that sounds an awful lot like a great exam question. Factor-oriented managers, they probably have highly diversified portfolios. On the other hand, a stock picker, the extreme is the example that I gave in the very beginning, where we put all of our eggs into that one basket, right? We ranked 100 stocks. We're going to put 100% of our wealth into that best expected performing stock, which of course then by definition means that we're going to have lots of idiosyncratic risk, which we could say it another way, lots of unsystematic risk. What does that mean? Lots of noise, and there could be luck, because who knows what's going to happen to that individual company, both at the micro level inside of it and the macro level outside of it. All right, so how do we summarize what we just did here in this breadth of expertise? And hopefully you remember conversations that we've had on information coefficient. There's the IC in the middle. Breadth, BR, and then a transfer coefficient, which is kind of an interesting concept. In finance, a lot of times we do things that say something like, okay, we've got this base, whatever this is, and then to compare it to this thing over here, what we need to do is we need to adjust it, right? That's like that when we did those futures contracts. We did we used the cheapest to deliver. And then somewhere in there we had a yield beta, and somewhere in there we had some other stuff. So that's what that transfer coefficient is. And so notice that expected return on the active portfolio is a combination of information, breadth, and then a transfer coefficient. So let's go ahead and just summarize these. And then look here, we'll have a quick example. So that information coefficient, that's just like the correlation coefficient, but it has a super special definition. It's the correlation between the forecasted active returns and the realized active returns. So just like correlation coefficient, the IC is going to have a range of between a -1 and a +1. And so these are probably good exam questions. Down that left-hand column. What does it mean if the information coefficient is 0? What if it's 1? What if it's -1? So you can always gather some usefulness by looking at the extremes. So if we have an information coefficient of 1, what does that mean? Well, what we forecasted to happen, that's exactly what happened. And what does that mean? Boy, that must mean that we're pretty highly skilled, right? Now, the breadth is the number of uncorrelated, independent decisions made by a manager during some time period, and the most common time period used is for a year. And so this breadth says something like, if I'm an index fund manager, and I make no decisions at all during the course of the year. I buy whatever is the market value of those 500 stocks. If this is the S&P 500, well, then my breadth is probably going to be 0. But then if I'm making a decision every day, like, oh, I think this stock is going to go up and I think this stock is going to go down, well, that's 2 uncorrelated, independent decisions on that day. And if I do that every day during the course of the year, well, that's a huge amount. That's why, and let me go back here quick. That's why I shouldn't have to remind you of this. We take the square root of this, because as we're moving through time, that difference, that variability, it moves through time at the square root. And then that transfer coefficient is going to be between 0 and 1. So that transfer coefficient is kind of, boy, don't let your finance professor hear me say this. It's kind of like an R square, which is going to be between 0 and 1. But it is essentially a measure of the level of constraint faced by the manager. So let's do a quick example here. Here's Emily, 150 million in assets under management, active risk of 3, information coefficient close to 0, right, 0.1, transfer coefficient of 0.3, 2% expected active return this year. The number of truly independent decisions that Williams would need to make in order to earn her expected active return is closest to, well, let's just do some algebra, rearrange that, and we get some massive number because of the active risk of that 3% there. So what does that say? Almost 500. Wow. All right, how are we going to construct our portfolio? We can use, all different sorts of taxonomy systems, but we'll go ahead and say, you know what? We've learned top down and bottom up from level one. That sounds like a good one, right? Top down, start with the entire economy, trickle your way all the way down to identifying those individual firms, or pick an individual firm and say, you know what, this individual firm is awesome, and let's work our way back up through the sector, through the industry, up to the macro economy to make sure that it's the best sector, it's the best industry, it's the best economy. And so hopefully, whether we use bottom up or top-down approach, when we kind of meet somewhere at the end, that we would come up with the same and identical portfolios. That's probably not going to happen in reality, but at least in theory, it makes some sense. And then the other approach is some systematic approach, also known as a discretionary approach, where we're going to say something like, and let me go ahead and just give the super simplest of example that I can think of based on an example with dividend yields. I mean, we might just say something like, you know what, we're not going to buy stock unless its dividend yield is, pick a number, 5% or 2% or 8%, whatever it is, comma, and the trend over the last 5 years is either upward or downward, depending on how you think. So imagine how many firms would fit into that category. And so if you start with $1 million and then you, after the comma, and you do the next thing and you get it down to 100,000, and then you keep getting it down and you reduce it, you narrow it until you get to, wait a minute, you get to the same kind of a portfolio over there of bottom up or top down. No, I'm not saying that these two, 1 and 2, are going to result in the same constructed portfolios, because they're probably not. But in theory, that if you use a systematic method and you use a top-down method for the same client, that you should arrive at a portfolio, 2 portfolios. They might not have the same 50 stocks, but those 50 stocks ought to have the same kinds of risk levels, depending on how you measure risk. All right, how about the difference between systematic and discretionary? All right, so we're going to do systematic first here. So these are rewarded factors. These are research-based rules. That's what I was saying earlier. Minimizes idiosyncratic risk. It's a formal portfolio optimization process that can result from these systematic strategies. And it's super likely that these are going to be well-diversified portfolios. Okay, so that's systematic. Now, discretionary strategies, and sometimes these two names get mixed up, but the discretionary strategies are going to be just a little bit different, because they're going to result in a higher concentration. So this is what I was saying earlier. What did I say? You start with $1 million, you go down 100,000, and all of a sudden you got 50. Well, under the systematic method, you're probably going to have a well-diversified portfolio. Under discretionary, you're going to keep narrowing it down until you're comfortable with those stocks. And let's say you have 50 with the systematic strategy and you only have, let's say, 20 with the discretionary strategy. This is what I was saying very early, and why I thought the reading was so clever by saying, let's invest all in one stock. That would be a corner solution. Clearly, that's not what we want to do. But what we can do is we can capture that active return by investing in a concentrated strategy. So don't get systematic and discretionary strategies confused. A lot of times those terms are used interchangeably, but for this reading, they're probably not. So I think the best thing is to remember difference between concentrated and unconcentrated portfolios. That should make perfect sense. Now, the bottom-up returns, the bottom-up methodology, these are going to emphasize security-specific factors like dividend yield. The top-down is going to rely on macroeconomic factors like size. All right, so that's the big difference. But notice, look at the first words there: rely on factor returns. Top-down, rely on factor returns. So that's a great similarity between the two, but they start with different factors. Think of just like market factor or momentum for top-down, and then think of dividend yields or some other kind of rewarded factor. That should make perfect sense. Now, here's a good table. I would take a picture of this. This is a summary of what I have been saying, and look at the words down at the bottom. In this slide, we use diversified and not concentrated, so make sure you can use those interchangeably. It should make perfect sense. Now, this is always my favorite part of these level 3 readings, when the Institute goes ahead and reminds us all that, hey, no matter what we're doing at kind of, individual silo levels in these individual readings, is that what matters most is the policy statement. So how does all of this fit into the policy statement? Look in the middle there, the objective function, which states the desired goal. So what's the desired goal for an actively managed portfolio? Well, a desired goal might be, okay, here's our benchmark. Whatever the benchmark is, we want 1% on top of that. Makes perfect sense. And here are a bunch of constraints, right, that limit the optimization process. So we can throw a bunch of these constraints in there. Now, in the context of the policy statement, those constraints, now remember, there are the 5 constraints. You have liquidity, you have tax, you have investment horizon, and you have legal and regulatory, and then you have unique circumstance constraint. And remember, you guys have heard me say this. When I teach this to my undergraduate students, I break the unique circumstance constraint down into 2 parts. I call one the unique circumstance constraint, and then I add a 6th constraint, and I call it a behavioral constraint. And I'm mentioning that to you, not suggesting that the Institute should adopt my kind of process, but remember now, any of the behavioral issues are probably going to be thrown into that unique circumstances constraint. So here are some examples of objective functions: maximize Sharpe, maximize information ratio. I mean, you could come up with tons of these. And then here are some mathematical constraints that you could put into the solver function, whether it has to do with individual security rates. Like, look at that first one here. We don't want any security to have more than 5% of the entire portfolio, or a sector 30%, or volatility, or we could have all sorts of constraints in there. Now, with the information ratio in there, we want to make sure we have the difference between our portfolio and our benchmark. So look at the very top. This is a great exam question, just dying to be asked. If the Institute says something like, hey, we want to maximize Sharpe ratio, I want you to close your eyes and I want you to think of the very top. That's an absolute framework, right? All of those things there are saying, all of those constraints are saying, this is what we absolutely want inside of our portfolio. But then if the goal is to maximize the information ratio, we need to compare that to the benchmark. So that's a relative framework. So know the difference between absolute and relative frameworks. And there we go. I just summarized all this in this table here. At the very bottom, the manager can also combine relative and absolute constraints, of course. And you know what is fascinating teaching, 20-year-olds or 21-year-olds? Is that when we work through this Harry Markowitz framework in Excel using the solver function, I'll have a student or a handful of students will say something like, hey, you know what, Jim, you can do this too. And we can, they'll say something like this. And so we put another constraint in there, and lo and behold, there comes another efficient frontier out. And so this is essentially what my students are trying to teach me, because, I'm 61 years old. What the heck do I know about technology? Combine the relative and the absolute constraints. Yeah, other approaches to optimization. I said this just a few minutes ago. It depends on how you define risk. Remember me saying that? Well, we can define risk in almost any way that we want to. The reading mentions downside risk and drawdowns or standard deviation of the portfolio, but that's not limited to, we could throw value at risk in there, we could throw exposure in there, we could throw probability distributions in there. I mean, really almost anything that we come up with could be an objective. But what we want to do, look at that third teardrop point. We want to maximize exposure to the rewarded factors that are a result of all the hard work that we have done, right? That should make perfect sense. All right, let's look at this last LOS, at least in part one. I said this is where the emphasis might be, active share and active risk. Let's go ahead and look through some of these definitions. So active share measures the degree to which the portfolio's holdings different from the benchmark holdings. All right, so this is allocation stuff. This was that What did we do in that first simple example? We went from 50 to 70 and 50 to 30, right? That makes perfect sense here. So an active share of 0, I think I hinted at this before, same holdings as the benchmark. Active share of 1, no holdings with the benchmark. I always find it fascinating when I take my investment students to the Morningstar software, and I'll just have the students, I'll say, hey, what do you guys know? Pick a mutual fund out there. So we'll find a mutual fund out there, and I always go to the turnover ratio. And sometimes we'll get high turnover ratios. And I ask my students, what does it mean to have a 100% turnover ratio? And, they say, well, it means something like this. And I'll say, here's what it means. It means that it has an active share of 1. That you started out with these 100 stocks, and at the end of the time period, you have 100 different stocks. That sounds like a turnover ratio of 100% to me. Active share of 0.5, so that makes perfect sense. So here's our equation for the active share. So look at the subscripts there, the P and the B. So the P stands for portfolio, the B stands for the benchmark. So all we're doing is summing the differences of the weights, and then we're going to cut it in half for a variety of reasons. Don't worry about what those reasons are. What are the active share sources? This is probably a good exam question. Portfolio holdings that are not included in the benchmark, and then portfolio holdings that are included but are weighted differently. And so this active share for all actively managed portfolios is going to have both of the, at least, boy, I want to say this, is probably most likely, almost guaranteed to have both of those sources. Now, active risk, on the other hand, is, look at that equation down at the bottom. So we're taking the square root. So we have a squared sign inside of that thing, right? That active return squared. So that active return is going to be the difference between the portfolio return and the benchmark return. So inside of that big square root sign, that's going to be a variance. We take the square root of it, and that's going to be our standard deviation, right? So look at the second embedded bullet point up at the top. It is the standard deviation of the active return. So remember that active share back here means one thing. That's just difference in weights. Here, active risk, sometimes called tracking error, is standard deviation. So that's an important distinction between the two, and that addresses that LOS here. Active risk, well, when we go back here, oh my gosh, hopefully you guys made this connection. When we divide it by t minus 1, we divide by the degrees of freedom. That must be sampling. So when I show you that first bullet point, it relies on historical returns. You shouldn't be surprised to hear all that. Now skip down to that bottom bullet point here. Unlike active share, active risk is impacted by the extent of this cross correlation between what's going on inside of our portfolio and what's going inside the benchmark. Yeah, so let's go ahead and ask this question, why? So let's take a look at two scenarios. So we have a manager who underweights one tech stock. All right, so what does this mean? Definitely increase the active share, right? However, if the two tech companies have a high correlation, that implies that the portfolio will behave almost identically, right? So we're overweighting one that has high correlation with one over here. Well, I don't know. That's probably not doing too much, right? That's not too much of an activity. That's kind of like, as my mother and my grandmother used to say, that's kind of like putzing, right? You go outside and you just putz. That's what my mom used to complain about me. Jimmy, you're putzing. Instead of going and running around the house. Running around the house, that's active investing. But when we're putzing, we're kind of faking like we're active share. So that's what that scenario is. But how about scenario 2, underweights one tech stock and overweights one staple stock? Well, then these two stocks probably have low correlations, so that's going to increase our active share and our active risk. Does that make sense? I think it does. So here's a good summary table. A portfolio manager has full control over their active share. That makes sense. The manager has no full control over active risk. So that's probably a good exam question there. Let's continue our conversation on this idea of decomposition. Going back to my first example, right? I did 20%, the benchmark did 12%. We want to figure out what in the heck was going on with that 8%. Well, of course, we can use our active risk, our standard deviation, our variance, and we can attribute those to factor exposure. So that's what we've done for you in the green box. All we're going to do is we're going to sum the difference between our betas, just like we did before, right? Beta of our portfolio for factor K, beta of the benchmark for factor K, multiply that by, the compensation to that factor, and then we're going to weight that by the standard deviation. So that's attributable to factor exposures, and then in the orange box over there, that's the noise or the luck. All right, here's really what we think are going to be very likely questions on the exam. Let's take a look at different investment styles. Now, these are taken right out of the reading, so you need to know these terms. A closet index manager, what do we have bolded there? Few active bets. So the manager steps out a little bit and then comes back, steps out a little bit, but doesn't ever go far, far away. Think about that. This reminds me, and this is a great story, I'm going to go ahead and tell you, even though it doesn't have anything to do with closet indexing, but it might prompt you to remember this on the exam. One of my sons, he ran away from home when he was about 4 years old, and he had a fan in his room, and so this is what he packed in his bag. He packed a pair of socks and his fan. And he went out and stood by the mailbox. All right. So he did not venture far away from home. And you have to ask yourself, you say, boy, Jim, that was not a good bag to pack. But you see this. So what he was staying close to home because he knew that he was not going to survive out there. So closet indexer. This is probably a manager who is restricted or constrained by the policy statement. And the policy statement says something like, you know what, go ahead and stand out by the mailbox a little bit, but then come back, right? Closet indexer. Diversified multi-factor investor. So look at what we have bolded there. Multiple factors. So what did we say earlier? Momentum or size. So we're going to combine those factors to get a diversified portfolio. Sector rotator. Now, this is not my son. This is going to be not one of my children, but maybe somebody else who would go way, way over to the next neighborhood in search of changing economic conditions as they relate to the equity securities inside of our portfolio. So what do we have in bold? Take advantage of changing economic conditions. So what we do is we actively search for undervalued industries or undervalued sectors or undervalued subgroups, however you want to define it. And our conclusion might be that, hey, over the next 18 months, we think that the construction industry is going to take off because lots of consumers have tons of money in their checking accounts, right? So they're going to start building homes. Well, changing economic conditions. So do you see, it makes sense to rotate into that sector. High tolerance for sector deviation. So if we're going to overweight the home construction factor, the home construction sector, well, then, maybe it's 5% in the benchmark. Maybe we'll go over there and have 20% or 30%. Concentrated factor investor. This is the same thing, but what we're going to do is we're going to focus on a small number of factors. Factor neutral. This, notice we have in bold, no active factor bets, but we diversify the portfolio over a range. The pure indexer, we know what that is. Concentrated stock picker. That's going to be that first person that invests everything in the best stock over there. Or maybe like we were talking about with the discretionary strategy, maybe we find those best 20. Here's a good graph. Active share over active risk. In fact, get out your phones and go ahead and take a picture of this. This probably is a great multiple choice question to identify where somebody is on this. I mean, the Institute could give you this graph and just pick a point on there and you would say this one is most likely to be, And pure indexer down there at the bottom left all the way up to a sector rotator. Yeah, that should make perfect sense. So here we're coming to the end of this slide deck. We have a handful of questions here. Notice the question there. Can you read that? Identify the manager most likely to be one of those four. So we think that this is probably the most likely questions here that are going to show up on your exam. So you'll get a table. So there are the four managers, right? A, B, C, and D. And we're given some constraints: active risk, sector deviations, and then risk contribution of a single security. So look just briefly at this table. Forget about the question. What you should draw your attention is that A has 12% target active risk. So you should have something in mind about that. And then D has 18% max sector deviations. Okay, so you have the two extremes there. So clearly A and D are going to be related to 12% and 18%. And I'll do that here for you in just a few seconds. Look at B. Boy, B has a 1 and a 4 and a 1. Boy, that's not too much variability, however you want to measure it. So B probably has some kind of a characteristic. And then C is probably somewhere in between all of those. So let's work through this here. All right, so A is likely a concentrated stock picker. That makes perfect sense, right? 12% target active risk, which was way higher than anyone else's. So tolerates significant performance deviations. Well, that makes perfect sense. They probably have a high tolerance for idiosyncratic risk. So that 12% there, that was probably the most important. You can look at the 6% there. I don't know if that's too terribly important, but the Institute does make a comment about concentrated portfolio as maybe further evidence that this is a concentrated stock picker. B, this is what I was saying, the 1, the 4, and the 1. This is someone like my son who's just out in the mailbox with his fan with nowhere to plug it in. Closet indexer. Low target active risk, so that makes perfect sense. Manager C, I said it's probably somewhere in the middle, multi-factor investor, mostly because of that single security of 1%. So this is going to be a highly diversified portfolio. And then that 12% of the large sector deviation, that probably is an indication of the use of a handful of factors, not just 1 or 2 factors there. And then D, here's our sector rotator. So substantial tracking error, high tolerance for sector deviation. So this is probably going to be concentrated portfolio. That makes sense? I think it does. So there we go. There's the first 3 LOSs. We'll go ahead and talk. Look at these next, we have risk. We got risk in all these other LOSs here. So part 2 will be lots of fun as well. I said this earlier, there are only 15 questions at the end of this particular reading, so I don't want you to go and look at any of those right now. After you watch part 2, I want you to go back and look at all 15 of those. So, hey, thanks for watching, and good luck studying.